For centuries, the gold standard was considered the foundation of sound money, the bedrock of financial civilization, the one true anchor that kept governments honest and currencies stable. Economists praised it, bankers defended it, politicians swore allegiance to it. The promise was simple and seductive: tie your currency to gold, limit what governments can print, and prosperity will follow. Discipline, stability, and trust, all guaranteed by the yellow metal that had captivated humanity for millennia. But history tells a different story. The gold standard didn't just fail to deliver on its promises, it actively broke the global economy, turning financial crises into catastrophes, transforming recessions into depressions, and trapping nations in deflationary spirals they couldn't escape. The very rigidity that was supposed to be its strength became its fatal weakness. And when the system finally collapsed, it didn't fall because of reckless governments or irresponsible spending. It fell because it was fundamentally incompatible with the modern world, a 19th century solution to 21st century problems that killed millions through unemployment, poverty, and the political chaos that follows economic devastation. Understanding how the gold standard broke the global economy requires going back to why it existed in the first place. For most of history, money was commodity-based. Coins were made of precious metals, primarily gold and silver, which had intrinsic value. A gold coin was worth the gold it contained, regardless of what government issued it. This provided a natural constraint on money creation. You couldn't print gold, you had to mine it, which was expensive, time-consuming, and limited by geology. Governments couldn't simply create unlimited currency because they only had so much gold. This discipline was attractive to people who remembered the countless times throughout history when rulers debased coins or printed paper money into worthlessness. By the 19th century, this evolved into what we call the classical gold standard, a system where currencies were defined as specific weights of gold and could be freely converted at fixed rates. The British pound was defined as a certain amount of gold. The US dollar was defined as a certain amount of gold. And because both were tied to gold, the exchange rate between them was fixed and stable. If a pound was worth $4.86, that relationship held year after year because both represented claims on gold at fixed ratios. This created predictability in international trade and investment. A British merchant could do business with an American partner knowing the exchange rate wouldn't fluctuate. Capital could flow across borders without currency risk, and governments faced automatic discipline. If a country imported more than it exported, gold would flow out to pay the difference. That gold outflow would reduce the domestic money supply, which would cause prices to fall, making exports cheaper and imports more expensive, which would eventually reverse the trade deficit. The system was supposed to be self-correcting, an automatic mechanism that maintained equilibrium without requiring government intervention. The golden age of the system, roughly from 1870 to 1914, is often romanticized as a period of unprecedented global economic integration and stability. Trade flourished, capital moved freely, countries grew rich, and the gold standard got the credit. But even during this supposedly golden era, the system was showing cracks. The automatic adjustment mechanism worked, but it worked through deflation and unemployment. When gold flowed out of a country, reducing the money supply and causing prices to fall, that deflation meant businesses failed, workers lost jobs, and living standards declined. The adjustment wasn't painless, it was brutal. And the burden fell on workers and small businesses, not on the financial system or the wealthy who held gold. Banking panics were common under the gold standard, far more common than they would be later under fiat currency systems. The reason is straightforward. Banks operated on fractional reserves, holding only a portion of deposits in actual gold while lending out the rest. If depositors lost confidence and demanded their gold, banks couldn't pay everyone. Runs would start, banks would fail, and the panic would spread. Between 1870 and 1913, the United States experienced major banking panics in 1873, 1884, 1890, 1893, and 1907. Each brought business failures, unemployment, and economic hardship. The gold standard didn't prevent these crises, it made them worse by limiting the tools available to respond. Central banks couldn't simply create money to provide liquidity because they were constrained by gold reserves. The only option was to let the panic run its course, which meant letting banks fail and economies collapse until the crisis burned itself out. Then came World War I, and the gold standard faced its first existential crisis. The war required spending on a scale no country had ever attempted. Britain, France, Germany, Russia all needed to mobilize their entire economies for total war. But government revenues couldn't come close to covering the costs. The traditional solution, borrowing, wasn't sufficient either. Who would lend the staggering sums required and on what terms? The answer was to print money. But the gold standard didn't allow unlimited money printing. It required maintaining gold convertibility, which meant reserves had to back the currency. So one by one, nations suspended the gold standard. They claimed it was temporary, a wartime emergency measure. But once suspended, the printing presses ran. Britain, France, and Germany all massively expanded their money supplies to finance the war. Soldiers, weapons, supplies, and everything else were paid for with newly created currency. The immediate benefit was that governments could spend whatever the war demanded without worrying about gold reserves. The long-term cost was inflation. Prices roughly doubled in Britain and France during the war. In Germany, they rose even more. And when the war ended, the world faced a choice: return to gold at the old parities, which would require painful deflation, or accept the inflation and devalue the currency relative to gold. Most countries chose a middle path that satisfied no one. Britain attempted to return to the pre-war gold parity in 1925, a decision championed by Winston Churchill, then Chancellor of the Exchequer. It was presented as a matter of national honor, proof that the pound was still as good as gold, that Britain remained the financial center of the world. But the decision was economically disastrous. Returning to the old parity meant the pound was overvalued by roughly 10%. British exports became expensive and uncompetitive on world markets. Unemployment soared, particularly in industrial regions dependent on export industries like coal and textiles. Wages had to fall to restore competitiveness, but workers resisted, leading to labor unrest culminating in the general strike of 1926. The economy stagnated. And all of this pain was self-imposed, the result of prioritizing the gold standard over employment and growth. Meanwhile, France did the opposite. They returned to gold but at a devalued rate, making the franc cheaper relative to gold than it had been before the war. This made French exports cheap and competitive. Gold flowed into France as the country ran trade surpluses. The French central bank accumulated massive gold reserves, hoarding the metal rather than allowing it to circulate through the international system. This asymmetry, Britain bleeding gold while France hoarded it, put enormous strain on the system. The gold standard was supposed to be self-balancing, but it only worked if countries followed the rules both ways, allowing gold to flow in during surpluses and out during deficits. France broke the rules by sterilizing gold inflows, preventing them from expanding the domestic money supply. This kept French exports competitive while starving the rest of the world of gold reserves. The United States played a similar role. America emerged from World War I as the world's largest creditor nation, and gold poured into the country as Europeans repaid war debts and bought American goods. The Federal Reserve, created in 1913, was supposed to manage the gold standard domestically, but it faced a dilemma. Following the rules would have meant allowing gold inflows to expand the money supply dramatically, which could fuel inflation. So the Fed sterilized the gold, holding it in reserve without letting it increase the domestic money supply proportionally. Like France, America was accumulating gold without fulfilling its role in the international system. By the late 1920s, the gold standard had become a trap. Britain was bleeding gold and couldn't reflate its economy. France and America were hoarding gold and refusing to inflate theirs. The gold exchange standard, a modified version where countries could hold reserves in foreign currencies backed by gold rather than gold itself, made things worse. Smaller countries held pounds and dollars as reserves, trusting that Britain and America would maintain convertibility. But this created a pyramid of claims on a limited gold base, multiple layers of promises, all ultimately resting on gold that didn't exist in sufficient quantities. When the Wall Street stock market crashed in October 1929, it triggered a global crisis that exposed every flaw in the gold standard. The initial crash was severe but not unprecedented. Markets had crashed before and recovered. But the gold standard transformed a financial crisis into the Great Depression. The mechanism was deflation. As the economy contracted, prices fell. Falling prices meant debtors, both businesses and individuals, found it harder to repay loans taken out when prices were higher. They cut spending, which reduced demand further, which caused more price declines. This deflationary spiral was exactly what the gold standard was supposed to prevent, but instead it enforced it. Central banks couldn't respond effectively because they were constrained by gold reserves. The Federal Reserve could have expanded the money supply to combat deflation, but doing so risked gold outflows if other countries lost confidence in the dollar's convertibility. So the Fed did nothing, or worse, it raised interest rates to defend the gold standard even as the economy collapsed. Banks failed by the thousands. Between 1929 and 1933, roughly one-third of all American banks disappeared, taking their depositors' money with them. The money supply contracted by about 1/3. Unemployment reached 25%. Industrial production fell by nearly half. And all of this was preventable. The solution was obvious: abandon gold, print money, reflate the economy. But the gold standard ideology was so deeply entrenched that policymakers couldn't see the alternative. The crisis spread internationally through the gold standard itself. When America's economy contracted, it imported less from other countries, which caused their exports to fall, which reduced their incomes and gold reserves, which forced them to contract their own money supplies. The automatic adjustment mechanism, which was supposed to stabilize the system, instead transmitted the depression from one country to another like a contagion. Every country was trapped. They couldn't reflate individually without losing gold and being forced off the standard, which was considered unthinkable, a sign of national failure and financial irresponsibility. The breaking point came in 1931, in Austria of all places. In May, Credit Anstalt, Austria's largest bank, collapsed under the weight of bad loans. The bank had been a pillar of Central European finance, and its failure triggered panic. Depositors across Austria and Germany rushed to withdraw their money, converting it to gold while they still could. The runs spread like wildfire. Germany's banking system, already fragile, collapsed within weeks. The German central bank lost its gold reserves. And in July 1931, Germany imposed exchange controls, effectively abandoning gold convertibility. They had no choice. The alternative was complete financial disintegration. The panic then turned to Britain. If Germany could fall, could Britain be next? Speculators began attacking the pound, converting sterling to gold and shipping it out of the country. The Bank of England watched its reserves drain away. France and America provided emergency loans, but they were exhausted within weeks. By September 1931, Britain faced a choice: raise interest rates dramatically to defend the gold standard, which would deepen the depression, or abandon gold. On September 19, 1931, Britain left the gold standard. The decision was announced as temporary, a wartime-style emergency measure. But everyone knew it was permanent. And something unexpected happened. The British economy didn't collapse. It recovered. Once freed from the gold standard's constraints, Britain could pursue expansionary monetary policy. Interest rates were cut. The pound devalued, making British exports competitive again. Unemployment began to fall. Industrial production increased. Within a year, it was clear that leaving gold had been the right decision, even though it had felt like national humiliation at the time. The lesson was unavoidable. The gold standard was the problem, not the solution. Other countries noticed. The Scandinavian nations left gold in 1931. So did Japan, and every country that left early recovered early. The correlation was undeniable. Countries that stayed on gold longer stayed in depression longer. France, which clung to gold until 1936, suffered prolonged stagnation and political instability that contributed to its collapse in World War II. The United States left gold in 1933 when President Franklin Roosevelt took office. One of his first acts was to ban private gold ownership and devalue the dollar against gold by 41%. It was presented as necessary to fight the Depression, and it worked. The American economy finally began recovering years after the crisis began. The data is conclusive. Economists who have studied the Depression agree almost unanimously that the gold standard was the primary mechanism that turned a recession into a depression and spread it globally. Barry Eichengreen and Peter Temin, among others, have documented how the gold standard enforced deflationary policies that destroyed economies. Countries that left gold early recovered early. Countries that stayed on gold suffered longer. And countries that never used gold, like China, which used a silver standard, largely avoided the depression entirely. The gold standard didn't just fail to prevent the worst economic crisis in modern history, it caused it. Yet the mythology of the gold standard persisted. After World War II, the victorious nations created a modified version called the Bretton Woods system. The US dollar was fixed to gold at $35 per ounce, and other currencies were fixed to the dollar. It was a gold exchange standard, not a pure gold standard, and it came with escape valves like the IMF to provide emergency liquidity. The system worked reasonably well for 2 decades, partly because it wasn't actually a rigid gold standard, and partly because the US economy was so dominant that the system essentially ran on American power rather than gold discipline. But the same fundamental problem emerged. By the 1960s, the United States was running large deficits to finance the Vietnam War and Great Society programs. The Federal Reserve printed money to accommodate government spending. Foreign governments holding dollars as reserves began to worry. If America was inflating its currency, their dollar reserves were losing value. they started demanding gold in exchange. The drain on U.S. gold reserves accelerated. By 1971, the situation was unsustainable. President Nixon closed the gold window, ending dollar convertibility. The Bretton Woods system collapsed, and with it, the last remnant of the gold standard. The entire global monetary system has operated on pure fiat currency ever since. The historical record is clear. Every time the world has operated on a gold standard or gold-based system, the result has been periodic crises, deflationary spirals, and economic pain concentrated on workers and the poor. The discipline the gold standard imposed wasn't on governments. It was on ordinary people who lost jobs, homes, and savings because the money supply couldn't adjust to economic needs. The flexibility of fiat currency, despite all its problems and the inflation it enables, is infinitely preferable to the rigid destruction of the gold standard. Yet calls to return to gold persist, usually from people who don't understand the history or who romanticize a past that never existed. They point to inflation under fiat currency and argue that gold would restore discipline. But they ignore the crushing deflations under gold, the banking panics, the mass unemployment, and the political extremism that economic instability bred. The rise of fascism in Germany and the political chaos across Europe in the 1930s were direct consequences of the economic devastation the gold standard enforced. When people are desperate, when democracy fails to provide prosperity, they turn to authoritarians who promise simple solutions. The gold standard helped create the conditions for World War II by turning an economic crisis into a catastrophe that destroyed the middle class and delegitimized democratic institutions. The fundamental problem with the gold standard is that it treats money as an end rather than a means. Money should facilitate economic activity, enable trade, and provide a stable measure of value. But the gold standard subordinates all of that to maintaining a fixed relationship with a metal that has no special economic properties. Gold is rare, durable, and shiny, but those characteristics don't make it the ideal basis for a monetary system. The supply of gold has no relationship to the needs of growing economies. Gold production depends on mining technology and geological luck, not on how many goods and services people are producing. This mismatch between gold supply and economic growth creates a deflationary bias. If the economy grows faster than the gold supply, there's not enough money to facilitate transactions, so prices must fall. Falling prices sound good, but they're devastating. Businesses can't profit when prices fall faster than costs. Debtors can't repay loans taken out at higher prices. Investment collapses because why build a factory today if you can buy it cheaper tomorrow? Deflation breeds depression, unemployment, and political instability. The gold standard doesn't prevent inflation. It enforces deflation, which is worse. The other problem is that the gold standard eliminates policy flexibility. When a crisis hits, governments and central banks need to respond. They need to provide liquidity, stabilize banks, and prevent panic from destroying the financial system. The gold standard prevents this. It's like tying your hands before a fight and calling it discipline. Yes, it prevents you from making mistakes, but it also prevents you from defending yourself. Modern central banks, whatever their flaws, can respond to crises by creating money, lowering interest rates, and providing emergency support. That flexibility saved the global economy in 2008 and again in 2020. Under a gold standard, both crises would have become depressions. The historical lesson is unmistakable. The gold standard didn't provide stability, it provided rigidity, it didn't prevent crises, it intensified them, it didn't protect ordinary people, it sacrificed them to maintain a fixed exchange rate with a metal. And when the system finally broke under the strain of modern economic reality, the countries that escaped it first recovered first, while those that clung to gold mythology suffered needlessly. Understanding how the gold standard broke the global economy isn't about rejecting discipline or embracing reckless money printing. It's about recognizing that monetary systems should serve human needs, not ideological commitments to arbitrary constraints. The gold standard failed every time it was tried because it prioritized stability of the currency over stability of employment, incomes, and living standards. It's a 19th century relic that has no place in the modern world, a failed experiment that should be remembered as a cautionary tale, not romanticized as a lost golden age. The next time someone tells you we should return to the gold standard, ask them if they understand what that means. Ask if they know about the banking panics of the 1890s, the deflation of the 1870s, or the Great Depression of the 1930s. Ask if they're willing to accept mass unemployment and economic collapse to maintain a fixed relationship with a metal. Because that's what the gold standard delivers, not prosperity and freedom, but rigid adherence to a system that broke the global economy and took decades to recover from. If this gave you a new perspective, hit subscribe. History doesn't repeat, but the same bad ideas keep coming back. and the gold standard is the worst idea that refuses to die.